Well, good morning. I was going to say Vietnam, but I'll say good morning, San Francisco. Hi, I'm Frank Stasiowski. Welcome here. I just want to take a minute to thank you all for coming and to start off this program. You're going to hear a heck of a program here today and tomorrow, and I think you're going to be really engaged in some of the information. Obviously, we've been doing this for, I think this is our 8th year now, and it's our biggest crowd yet, so thank you all for being here. And by the way, isn't it great to have a decent economy for our industry? Yeah, how many people are busy right now? Raise your hand. I love it. Good stuff. Boy, a lot better than when we started this thing. All right, so I'm going to bring up John Doring. Where's John? John, where are you?
I'm back here.
Oh, he's hiding back there. There he is. John is going to be your MC for this program. I'm going to get off. I'll handle questions and answers at the end. Listen to the data. We're going to have CNN live from Atlanta in a minute. But John, come on up and start the whole program.
Hashtag PSMJ Thrive. Wake up, San Francisco. It's time to thrive. Stand up with me. Let's get some energy going here this morning. Come on, let's go, let's go. Stand it up. Let's get some energy going here. Thanks for coming. Yeah. Yeah. All right. Super, super. All right. All right. Welcome, welcome, welcome. All right, sit down. Thank you so much for coming. We are so pleased to have you here. And we, the PSMJ family, feel really, really blessed to be here. And the reason is this. This is what we do. This is who we are. Helping organizations and leaders just like you in this industry to figure out how to thrive. How to plan for the future, how to grow your business, how to be more profitable, how to be successful sustainably, to thrive. That's what we do. That's our calling. And that's why we're here, and I suspect that's why many of you are here. So this conference is about connections. This conference is about sharing and learning and collaborating with one another. This conference is about success, about how to thrive. Sound like the right place for you today? Yeah? You ready for some of that? I know we are. So let me start off and just give you a thought to think about in terms of making this connection between what you do, how you act, and success. Let me just share this idea with you. Something that I think I've seen many times in my career. So here it is. Successful organizations are almost always run by successful people. Well, that's a breakthrough, isn't it? Successful organizations are led by successful individuals. Make sense? Sure, right? These successful individuals are often, what I've seen, people who think and act differently from others. Successful organizations, successful leaders. What are successful leaders? Oftentimes, people who think and act differently from others. Do you know what I mean? People who have different perspectives on things, people who see possibilities where others don't, people who often have really, really different, even very disruptive paradigms about what's going on around them. People who think and act differently. Let me give you just a brief example of how I think that looks. I want you to suppose with me for just a minute that you could be 8 feet tall. Got to get that picture in your mind. What if you could be 8 feet tall? Now, I know you can't, it's not possible, but just work with me for a minute. If you could be 8 feet tall, do you think you would have a different perspective on things? Yes? Do you think you would sort of act differently? Maybe you'd have to duck to come into the room. Maybe you'd be doing something completely different with your life if you were 8 feet tall. What would you be doing? What would you be doing if you were 8 feet tall? Taking advantage of it how? What would you do? Play basketball, wouldn't you? If I was 8 feet tall, I'd play basketball. Wouldn't you? Listen, playing basketball can't be any harder than what you guys do for a living, is it? But you can't be that, and so some of you right now are thinking, boy, I sure hope they have something more pragmatic to say in the next 2 days than that. Because it's impossible to be 8 feet tall, or is it? You see, I said it was impossible, and I bet a lot of you just followed along with me, but guess what? That isn't even true. Not only is it not impossible to be 8 feet tall, it's actually really easy. It's trivial. All you have to do is be willing to think and act differently from everybody else. So I can be 8 feet tall. Now, think with me. How many of you in the room right now are thinking, let's see, John is about 2 inches shy of 6 feet tall. The chair is 17 inches off the ground. He's at least, is anybody doing that right now? My engineering friends? I'm 4 inches short of the goal here. Look, will you guys work with me a little bit here? It's no trouble at all to be 8 feet tall. But let's talk about risk for a minute. What's the risk of standing on a chair? What's that? You can fall down. Okay. What else? Any other risks? What's the risk of standing on a chair? Somebody said chair breaks? Chuck, did you say the chair breaks? Is that a fat joke? Are you going to be like this all day? Okay, the chair could break. Yeah, you could fall off, the chair could break. Those are what I call operational risk. They're the kind of risk in our business and our life that we see all the time and we learn how to manage or mitigate. Lots of those kinds of risk in your business. So in my example, I come down to the room the night before, all the chairs in the room have wheels, then we're not going to do this. I'm not going to do this little thing if all the chairs have wheels on because that's too dangerous. What about another kind of risk, though? Anything else? Okay, you get stuck. That's true. Anything else? Yeah, what'd you say? Who said that? Right. Think about that. Here's the risk of standing on a chair in front of all you people. I look what? Dumb, stupid, different, standing out. This is the risk you've got to overcome. I know I look dumb and stupid. This is what I do for a living. But I'm okay with it because the point is super, super important. Want to be a successful organization? Be a successful leader. Want to be a successful leader? Think and act differently than others. Make sense? That's what I want you to be thinking about at this conference. Suppress that instinct that says, oh, I kind of know that. I heard that already. There's nothing new on that. Look and learn. We're really, really glad you guys are here. We're so looking forward to this. This conference is about connection, sharing, knowledge, success. You've already taken a step to think and act differently because you decided and committed to be here today. Now, you ready to take another one? How about let's take a second step together into the circle of excellence. You ready to thrive? All right, I'm going to ask you to do one more thing, and then I won't talk anymore, and that's this. Would you stand up with me one more time? And this time, what I want you to do is congratulate yourself, your team, your firm, and this industry for the success that you have achieved. Because guess what, ladies and gentlemen? You've earned it. Stand up. Let's do that. Darnell, help us. Come on. Come on. Congratulations. You earned it. And you've earned it. AEC! Good job. Good job. All right. How many of you are wondering if we're just going to do this all day? Well, why not? Well, why not? All right. So let's get started right now on the information sharing. And so it's going to be my pleasure to introduce our first keynote speaker, Dave Burstein. A lot of you guys know Dave. Dave's been a big part of PSMJ for a long time. He is the Director of Client Services here, and his responsibilities include many different things, but primarily providing consulting and training on subjects that include strategic planning and marketing and project management and HR issues, quality, finance, ownership transition. He's done much of it in this organization. Dave's got over 35 years of experience in managing engineering firms himself. He was a senior principal at Parsons Corporation, and he held a variety of positions there, including president of the company's 1,600-person environmental subsidiary. Dave's been a consultant with PSMJ for a really long time. He did that on a part-time basis from 1979 until 1998 while carrying a full-time job at Parsons, but he's been full-time with our firm since 1998. And during that time, he has facilitated scores and scores of strategic planning engagements, and he's presented over 100 different seminars. Dave is the principal collaborator in our book, Strategic Planning, Preparing Your Firm for Success in the Future, which in 2000 had a second edition and is one of our best sellers. Also, since 1979, Dave has written and lectured extensively on the subject that I most associate with in project management. He co-authored with Frank our book, Project Management for the Design Professional, which is now published in both English and Spanish versions, and another, Total Quality Project Management. Dave's been a registered professional engineer since 1974. He's a diplomat of environmental engineering, and he's not here. Plan A is that Dave was going to be here with us, like the rest of us here on the team are, but at the last minute, he had some medical issues in his family, which required Dave to stay where he is right at the moment, which is in Philadelphia, Pennsylvania. So here we go with a 21st century experiment. It's my pleasure to bring now to the stage, through the magic of technology, Dave Burstein.
Well, thank you, John. Is it sound okay on this one, John?
Sounds good from here, Dave.
Okay, well, first of all, let me express my regrets for not being able to be there personally with you, as I have been in past years. John mentioned I had a last-minute family medical situation, hopefully nothing too serious, but forced me to stay here in Philadelphia. So since you guys are in the heart of information technology, America and I guess the world, we'll see if the information technology on this little thing holds up for the next hour or so. So what we're going to do is talk about where we see the AEC markets in 2016 and beyond. We're going to talk about, first of all, some trends that we see in the overall U.S. economy and Canadian economy too, because I know we always have some Canadian friends here. We're going to look at our outlook for 2016 and beyond, look at which markets we think are going to be up, which markets are going to be down, and then we'll talk about what you should do about it. So we have lots of data. I hope you guys like charts and graphs, because boy, we got charts and graphs. The good news is that all this stuff's available to you. You don't have to take notes fast and furiously, but there's a lot of information here that I'm going to cover pretty quickly. Let's start with some trends in the overall economy. And I want to preface this presentation by saying I voted for Mitt Romney in the last election, even though the rest of these slides may sound like I'm a big Obama supporter. But I look at the data and I try to be as rational about the data as I can. And the overall trends in the U.S. and Canadian economy are pretty good. So let me just go through that. We're seeing a lot of anger about our economy from people like these guys here who all want to be the next president of the United States. And I'm not sure exactly why that is, because the data really doesn't support it. If you look at the GDP worldwide, what you see is North America, which is the US and Canada basically, has one of the highest GDP growth rates in the world. The only people that are higher than us are Middle East and North Africa and Sub-Saharan Africa and Asia. Those are all emerging economies. If you look at the economies that are already developed, you look at places like Japan, Western Europe, Eastern Europe, our growth rate is way better than theirs. We're the envy of the developed world. If you look at unemployment, which has been a bugbear since the recession, what you see is that based on initial jobless claims, we're at the lowest number of initial jobless claims that we've been at all the way since the data began in January of 1967, the lowest. So the job picture is very bright. Here's one that surprises a lot of people. Everybody thinks that our deficit is totally out of control, and while I think it's a bit higher than it ought to be, there's been some major moves since the recession. We were creating a deficit of about 10% of gross domestic product. Actually, that's actually dropped down to about 3.5%. In fact, the deficit today is lower than the historic average has been going all the way back to 1975. If you look at the 2016 and 2017 budgets that were just passed, you see that those budgets actually continue to reduce the deficit. The reason for reducing the deficit, I think, is maybe even more surprising. Some of it has been due to pretty substantial revenue increases that have happened since the recession. But a lot of it has been due to basically a flatlining of expenditures since the recession ended. Federal expenditures have been essentially flat since the end of the recession, and because revenues have grown, it's shrunk the deficit. Now, a lot of this has to do with the sequester that was passed that occurred over the objections of both the Democrats and the Republicans, but the good effect of that has been to flatten out federal spending. If you look at federal spending as a percent of gross domestic product, that's also way down. It was up to over 25% of gross domestic product, down now to 22%, which is getting pretty close to the historical average. This is an even more impressive picture. If you look at household balance sheet, assets versus liabilities, household liabilities have increased, on balance, this is the U.S., to $14 trillion. Assets, on the other hand, have increased to $100 trillion. So the amount of assets minus liabilities, the net worth of U.S. households, has never been stronger than it is today. You can see there was a little bit of a dip here during the recession, but it's come back much stronger than it was. The liabilities have flattened out, and the assets have gone right on up. Interest rates, when we say interest rates are at historically low rates, this chart goes back to 3000 BC. And since 3000 BC, interest rates have never been this low. So that's not going to hold up forever, but I think it's really interesting just to see this kind of a comparison. If you look at how competitive the United States is, we're up there in pretty good shape. We're ranked, according to the World Economic Forum at Columbia University, as the third most competitive economy in the world, just after Switzerland and Singapore, both of which are much, much smaller economies than ours. So that sign is very positive. If you look overseas at what's happening in China, if you remember back this summer, there was a major dip in the stock market because everybody was concerned about import demand in China slowing down, and in fact it is. In China, the only real growth that they're getting in the GDP is from the financial sector. The construction has been going down, industrial production has been going down. The Chinese economy is not cranking it out the way it used to. And if it wasn't for the increase in the financial sector in China, they would probably actually be in recession right now. The good news for us is that both the U.S. and Canada have really very little exposure to what's happening in China. And when you look at places like Taiwan, Korea, Chile, Australia, those places rely on China as a market for their exports, for a pretty high percentage of their exports. The U.S. and Canada is around 1% of GDP. All of our exports to China are only about 1% of GDP. So even a fairly substantial percent drop really has very little effect on the U.S. and Canada. When people finally figured that out, the stock market went back up to where it had been. Now, does that mean we're never going to have another recession? No, we will have another recession. Guaranteed. The cyclical nature of the economy has not been repealed. We will have another recession. The current cycle right now, since the last recession, is about at the average rate that it's been since 1960. So at some point, we're going to have a recession. I don't think it's going to be this year or 2016 and probably not even 2017. This is probably the best indicator. It's the spread between long-term interest rates and short-term interest rates. And just about every recession has been preceded by a dip. You can see the little red circles here ahead of each recession. We're not there right now. So this may happen, but right now, for the short term at least, it looks pretty good. This is an interesting survey of millennials and Gen Xers compared to baby boomers. And when we asked, when this survey asked all three age groups, what do they think about the local economy? You can see the most optimistic were the Gen Xers, the millennials. The next most optimistic were the Gen Xers. The least optimistic were us baby boomers. When they asked about the national economy, again, the same pattern. Both the millennials and the Gen Xers were much more optimistic than us baby boomers. I personally think that they're right on both those accounts, even though I happen to be in the baby boomer generation. I don't consider myself among those pessimists. Now, the global economy improving over the next 12 months, I'm not so sure about that one. I think the global economy will continue to struggle for a while. The biggest problem that we have in today's economy is no longer employment, but the biggest problem is lack of personnel. This is a graph of small businesses who are seeing few or no qualified job applicants for their openings. And you can see this is running at a rate that's higher than it's been in decades. The other thing that's causing is average hourly wage growth. And I believe that we're going to start seeing some significant wage growth that we really haven't seen since the recession. So let's talk about our industry, and let's talk about some data that PSMJ generates. Once a quarter, we do a market survey, a very extensive market survey. It's free. It's a free service to the AEC industry. We survey 50 some odd different markets and submarkets. The input is restricted just to AE firms because the construction firms are really kind of on the lagging end. We want to get the leading information. So it comes from the AE firms. Generally, somewhere between 200 and 500 people respond to these surveys. So they're pretty robust surveys. They really represent a good cross-section of opinions from knowledgeable people in the industry. We use the data that we generate to chart what we call a plus-minus index. Let me just show you how that works. Let's say one of the questions is, are revenues in the transportation sector increasing or decreasing compared to last quarter? And that's basically how all the questions are asked. What do you see happening this quarter versus last quarter? So let's just say that 185 people answered that particular question. And let's say that 60 of them said, we're seeing more revenue this quarter than last quarter in transportation. So we count that as 1 point. That gives us a total of 60 points. Let's say that 80 firms responded by saying, we see about the same level of revenue this quarter as last quarter. We count that as 0 points. And let's say that the rest of them all saw a decrease. We see less revenue this quarter than last quarter. We count that as minus 1 point. So we add all those up. It comes with a total of plus 15 in this example. We divide that by the 185 people who responded, and that gives us an index of plus 8%. It doesn't mean that there's 8% revenue growth. It's just an index. I'm going to be showing a lot of charts and graphs where the y-axis is this index. This is how it's calculated. Anything above 0 means people are seeing an increase. Anything below 0 means they're seeing a decrease. So let's start with revenues. And what you can see here is, here's the recession right here. But the good news is not only have we had 21 consecutive quarters of increasing revenues, the rate of increase seems to be accelerating. There seems to be an upward slope to that curve. So again, that's a very, very positive sign because we look at the slopes of these curves, not just a snapshot of where they are. That's resulted in a very similar backlog curve. Again, here's the recession, here's the recovery. When we ask firms about how they feel about future revenues, also a lot of optimism. And again, you can see very strong trend here. When you plan your firm's strategy, you really need to take the advice from the hockey great Wayne Gretzky. And his advice was, if you want to be successful in hockey, don't skate to where the puck is, skate to where it's going to be. And what that means is, don't plan your strategy around what the hot markets are today. Plan your strategy around what you think the hot markets are going to be a year from now, 2 years from now, 5 years from now, maybe even 10 years from now if you can see that far. Because it's going to take you that long to execute a strategy to get into those markets. A lot of times we'll see people making strategic decisions based on what's hot today, and by the time they've implemented that strategy, that hot market is now cold. We find that most predictions tend to be wrong because of two things. They tend to look at lagging indicators, at where things were in the rearview mirror rather than where things are going to be. And they tend to extrapolate the past into the future. We look at two different things. We look at leading indicators and we look for inflection points where trends are turning around and changing. Going back just a couple of latest slides here, you can see here's an inflection point right here. This really represented the bottom of the trend chart, even though it wasn't the bottom of the recession, and the bottom of the recession didn't happen until later. But when we see things turn around like that, that's a real important indicator to us. So let's talk about leading indicators. The first thing that happens that we see is if things are picking up, we see AE firm proposal opportunities increasing. If things are turning down, we see them decreasing. That then generates an increase or decrease in backlog, which then generates an increase or decrease in revenues for A&E firms, which then generates improvements or worsening cash flow in A&E firms. And on the construction side, that's where you start to see construction firm revenues. And that whole cycle takes about 1 to 2 years. And so if you really want to know what's going to happen to A&E cash flow or construction firm revenues a year or two from now, you don't look at revenues, you look at proposal opportunities. So that's really what we focus on. So when we ask people in our quarterly survey about proposal opportunities, this is what we see. We saw a bottoming out right here around the fourth quarter of 2008. And since then, proposal opportunities have been on a nice upward trend. And so not only have people seen more proposal opportunities quarter over quarter, the trend has been actually positive. For those of you who remember calculus, the first derivative of this slope is going upward. When we break it down by region, we see positive results. This is the most recent survey for the third quarter of 2015. The survey is currently open right now for the fourth quarter, which is happening this month. But we see a positive plus-minus index, in fact, a very positive plus-minus index in every single region. Now, one thing that has changed, in previous years, we saw Canada having a stronger plus-minus index than any of the U.S. regions. That's flipped a little bit, and now all of the U.S. regions actually have a stronger plus-minus index than Canada, but Canada is still fairly positive. So let's look at specific markets, which ones are up and which ones are down. The first thing I want to look at is the energy picture. And Every year that we do this, the title stays the same. It's called this changing energy picture because it always changes. And if you take a really historical long look at the energy picture in the United States, what you see is from 1776, when we first became a country, until about 1850, all of our energy was derived from wood. And then starting around 1850 and peaking around 1900, it's all been from coal. And then coal has been gradually decreasing, had a little bit upturn and kind of flatlined, and now is decreasing again. That's been replaced by petroleum. Petroleum now is starting to actually turn down, and that's being replaced by natural gas, renewables, hydroelectric, nuclear, and other things. So you can see that the mix of energy has changed significantly over the decades. If you look a little bit more recent history, back since 1990, you can see that natural gas has changed a lot. Shale gas didn't even exist until about 2005 right here. And now you can see, projecting forward to 2040, by the time we get to 2040, shale gas is going to be the dominant form of gas in the United States. And by the way, that's the good thing is, while the United States has lots of gas in a variety of forms, shale gas in particular is very plentiful. Another thing that's happening is, and this is one of the main reasons why petroleum usage is down, is that cars are becoming a lot more efficient. In 2012, the federally required CAFE standards, which is the average fuel economy for auto manufacturers, was around 30 miles per gallon. Next year, it's going to go up to 35.5, and by 2025, the car manufacturers are going to have to average almost 55 miles a gallon. So that's going to be a lot less fuel for the same amount of miles, which, by the way, has a negative impact on gas taxes, but that's a whole other issue. So as a result of all that, what we're seeing is that the overall economy is really becoming a lot more energy efficient. For a lot of years, the change in GDP went up in lockstep with the change in energy consumption. But now what we're seeing is the change in GDP continues to go up while the change in energy consumption has pretty much flattened out. So we're generating a lot more economic activity, a lot more growth with a lot less energy. As a result of all that, we've become a lot more energy independent. We've gone in just a few years, from 2008 to 2015, we've gone from importing 11 billion barrels of oil per day all the way down to about 4. That's a huge decrease. And what that's allowed us to do is to rely on our imports from places like Mexico and Canada, which are a whole lot more secure than some of the places we were getting it from before. That's a huge impact on our economy. On a global basis, we're seeing similar things happen all over the world. So oil demand is flattening worldwide. And that's really caused oil prices to drop as much as they have. And they've been now trading generally in the $40 to $50 a barrel range for some time. It's really, you can see how steep the curve is, and it really came down. The effect of that on the U.S. economy is overall very positive. Every time gas prices drop by a penny a gallon, it puts $1 billion of purchasing power into the U.S. economy. So when gasoline prices drop by $1 a gallon, that's equivalent to a tax cut of $100 billion in the U.S. economy. But there is a downside, and that is when oil prices go down, we start producing less oil. And you can see that the increase that we've had has started to turn around into a decrease. And if oil continues to stay low, which it probably will for a while, the amount of oil production in the United States is probably going to suffer. This has had a particular effect in certain states. Those states where they are very oil-intensive economy, which are basically these states down here, have achieved over the past 6 months essentially zero growth in their economy. So you can tell if your firm operates in those states, it's probably had a significant negative effect on you. On the electricity side, we're seeing a similar disconnect in terms of the demand for electricity. And whereas electricity demand used to go up by 10 or 12% per year, it's now only going up by about 1% a year. So what that's doing is it's basically reducing future capital investments in all kinds of energy industries. Another interesting thing that's happening is on renewables. We're seeing particularly solar costs have just absolutely plummeted, and solar costs are on the verge of becoming economical against fossil fuels. That's can have dramatic impact on the whole economy. Again, depending on where you are, it may have significant differences. Here are different states, and you can take a look at those. You can see the states that you're operating in and see what percentage of energy is going to be coming from renewable sources in those states. And if you happen to be in the states where they're seeing a lot of renewable energy, like California, that's potentially a really good business to be in. All right, so much for the overall economy. Let's take a look at the PSMJ proposal data. And this is by sector, where we look at proposal opportunities, both quantity and quality and magnitude of proposal opportunities. And we started this all the way back in 2003. And you can see that overall proposal opportunities in the energy and utility market have never dropped below zero. There was no recession in this market. Each of these spikes is year-end data, but the most recent data is for the first 3 quarters. So we've superimposed that. And the reason we show it this way is because there is some seasonality to this data, so that you can kind of compare that. And you can see even during the recession, even though there was a drop, quarter over quarter, there were still more proposal opportunities during the recession each quarter than the previous quarter. Now, the good news about this, in this area here, is it seems to be trending up. If we look at it by geographic area, it seems to be pretty uniform in every geographic area in the U.S. and Canada. If we look at the utility and energy submarkets, it's a little bit more of a mixed picture, though. Renewable energy is very strong. Power plants, on the other hand, is actually weak. We're actually seeing decreases in proposal opportunities in power plants. And we see fairly flat proposal opportunities in utility distribution, telecom, and pipelines. So here it's more of a mixed bag. Moving on to the manufacturing sector. 5 years ago, we were pretty much alone in predicting a manufacturing renaissance in the United States. Everybody at that time was bemoaning that we're losing our manufacturing edge, and everything's made in China, and we saw data that showed a real turnaround there and a real inflection point that it's leading to a manufacturing renaissance in the U.S. And the reasons for that, one of the things that drove manufacturing overseas was the big wage difference between the U.S. and China. Back in 2005, not that many years ago, the ratio of U.S. to Chinese wages was 22 to 1. 5 years later, went down to 10 to 1. This year, it's only 5 to 1, and you can see, based on current trends, those gaps are closing significantly. So we're not seeing that big benefit in manufacturing going to China from a wage standpoint. There's another problem going to China, and that is it's a long way off. And there's bad things that can happen between here and there, and supply chain interruptions have really been a problem. Another problem is intellectual property theft. Here's a guy who's not only peddling a product that looks just like an iPhone, he's even dressed like Steve Jobs. And there's a lot of concern among tech companies who are manufacturing in China about having their products stolen. As a result of all that, what we've seen is after a substantial rise in imports from China, it's pretty much flattened out after the past few years. So Chinese imports aren't increasing the way that they used to be. In the short term, the strong dollar has really hurt manufacturing. You can see this is what's happened to the dollar, and that's basically made our products more expensive overseas, and it's made overseas products cheaper here. So there's been a short-term negative effect on that. And as a result of that, we've actually seen for the last couple of quarters manufacturing drop in terms of manufacturing sector growth quarter over quarter. The question is two quarters really a trend, or is it just a blip? Don't know yet. If the dollar stays strong, it may continue to be a trend. Right now, my bet is that it's more of a blip. Let's look at A&E proposal activity in the manufacturing sector. Unlike the energy and utility sector, we did see a pretty dramatic drop in proposal opportunities during the recession. It came back around 2010, and you can see it's been positive ever since 2010. And the most recent 3 quarters are still positive, although the trend looks like maybe a little bit negative there. If we look at the geographic regions for opportunities for heavy industry, the one that does jump out is Canada, and that is actually negative. If we break it down based on light industry and heavy industry, light industry actually looks somewhat better here. Fairly positive plus-minus index for the past 3 quarters. If we look at all the regions for light industry, even Canada looks a lot better. So light industry seems to be holding up better than heavy industry, and that's probably due to the strength of the dollar, which has more negative impact on heavy industry than it does on light industry. If we break that down by submarkets, look at all the industrial submarkets, we see a lot of red here. Mining, primary materials manufacturing, petroleum facilities, chemical plants, repair and service facilities. We're actually seeing a decrease quarter over quarter in proposal opportunities in those quarters, in those sectors. On the other hand, pharmaceuticals, component assembly, warehousing, distribution, those are positive. So this is kind of a mixed bag. And we need to just keep watching these every quarter and seeing where the trends go. Let's talk about the housing market. Similar to the manufacturing market, back in 2010, when everybody was predicting gloom and doom for the housing market, we actually predicted that it was going to come on strong. And if you look since 2010, this is the number of new housing starts. This blue dashed line right here is the approximate sustainable level of housing. There's about 1 million new household formations per year that require additional housing. So we have a long-term demand, just based on population growth, of about 1 million new housing units per year. And you can see recently it's actually been higher than that to overcome what had been a shortfall, but the trend is a little bit down. That's actually probably a healthy thing, because it really needs to get back down to that 1 million home starts per year, and then it'll be at a nice sustainable level where we don't have the kind of bubble that caused all the problem in the last recession. Another big factor in the housing market is mortgage debt, and you can see that there's been a big drop-off in mortgage debt. It went from huge amounts of debt, much less. Now it's starting to come back a little bit, but mortgage debt right now is at a pretty healthy level. That's on a national level. If you look at it state by state, it's a little bit higher than that in some states. New Jersey, Florida, Nevada, Maryland tend to have above average mortgage debts, and so the housing markets in those states are probably not as robust as they are in states that have stronger mortgage debt situations. Another way to look at the housing market is how many people are moving into a state versus how many people are moving out of a state. So this is data from moving companies that indicate how many people are moving their household goods into a state, those are the blue states, versus how many are moving out of the state, those are the yellow states. So you can see the migration from a lot of the northeast states that are yellow, and Canada too is more people moving out than moving in, versus a lot of the Sun Belt states, which people are either moving into or are fairly neutral. The red is neutral. So again, you have to look at your own markets If your markets are in these blue states, chances are your housing market is much stronger than if your markets are in the yellow states. Let's look at our proposal activity on that. So we saw a huge dip in the housing market during the recession. The plus minus index went down to minus 80. When you consider that minus 100 means that every single respondent says it's going down, that's pretty close to a disaster in that market, and it pretty much was. But the good news is that, especially since about 2011, the market's actually come back quite nicely. If we look at the housing market on a regional basis, all the regions are pretty strong. There's a particular part of the housing market, though, that I think is worth looking at, one subsector of that, and that is the subdivision market. And the reason that that's so important is when people are building new subdivisions, like the one in this picture, they're building new shopping centers, they're building new hotels, they're building roads, they're building bridges, they're building water treatment plants, they're building sewer lines, they're building schools, they're building power plants, they're building transmission lines, they're building city halls, they're building libraries. So when you look at all of the A&E industry, what you see is that the housing subdivision, submarket, drives about 80% of all the revenues in the A&E industry. So this is a really important sector for us. So let's take a look at this. This sector was hugely negative. I mean, you look at the bottom of the recession right here, it was about minus 90 on the plus minus index. It started coming back and, became less and less negative, and then it finally, around 2012, it broke through and became positive. But you can see the trends since then have actually been pretty good. So this is a very strong indicator, not just for the housing market, but for about 80% of the A&E market. Looking forward, builders are saying that the cost and availability of lots is among their biggest problems, and we're seeing more and more builders saying that. That's not only good news for the civil survey firms that are designing these subdivisions, but it's also good news indicating that builders are going to be building more of them. If we look at the subsectors, the submarkets in housing, every single one of them is strong and positive. Moving on to the commercial markets, we've seen a great recovery in those. Again, here's the recession, here's the recovery. This is for commercial developers. By geographic region, commercial developers are all strong in every region. If we move on to commercial users, those are people who own their own facilities, like the big box stores. Very similar pattern, recession, recovery. Very similar outlook by geographic area, all positive. If we look at it by submarket, they're all positive. A couple of them are kind of flat, retail buildings that are for lease by developers or owners, and call centers and data facilities are flat. They're not really down, they're just flat. The rest of the submarkets are all positive. We move on to environmental markets. They actually did not have a recession. We saw quarter-over-quarter growth throughout the low point. It went down, but never went negative. But it looks like there may be a slowdown in the environmental markets. If we take a snapshot of the most recent regional data, it all looks pretty good. If you look at the submarkets, that's, again, kind of a mixed bag. Waste disposal, landfills and so on, we're seeing less proposal opportunity. Site cleanup is kind of flat. Resource management is flat. Air pollution is flat. The other submarkets are still positive. So, again, environmental depends on what submarket you're in or you want to get into. Looking at the healthcare market, looks very strong. Again, never had a recession, had a little bit of a low point, but never went negative. And it's been pretty strongly positive at about a plus minus index of 50, which is very strong. Look at it regionally, again, very strong across all regions. Look at it by submarkets. We're seeing a little bit of a flattening in hospital design and construction. The others are all positive. But there's another factor going on in the healthcare market that beyond just the market itself. And If you look back at 2007, we calculated that the profitability of firms that did more than 50% of their revenue in the healthcare market was 8% higher than the overall profitability of the A&E industry back in 2007. In other words, they were getting a premium for their services. That 8% premium dropped to about 2.5% in 2008. And if you look at the long-term trend, this blue dashed line here, it's actually turned negative. And in fact, in the most recent 2 years, firms that are doing more than 50% of their work in healthcare are actually less profitable than the overall A&E industry. So what we're seeing here is that even though the market is growing in the healthcare sector, the number of firms getting into that market is growing even faster, and the market's becoming saturated, and that's pushing pricing down, and that's pushing profitability down. If we look at the public sector markets, interesting thing happened to the public sector. If you look at all of the different recessions that have happened since Ronald Reagan, what we see is under the current recession, when we look at payroll jobs, this is public sector payroll jobs, gained or lost. This is the only recession where those job losses have gone on for this long. Other recessions either had no job losses or they recovered very quickly. You know, when public agencies are cutting their own staff, they're in trouble. And that's been happening in this recession. The good news is, as I mentioned before, government finances have improved. At the federal level, the federal budget deficit has gone down from 10% of GDP to about 2.5% of GDP. And you can see at the local utility level, here you saw a big dip in employment of employees in local utilities. That seemed to have bottomed out around 2013, 2014, and they're starting to hire again, which is a signal that local agencies are having money again. If we break it down by sector, looking at transportation, actually not been too bad. Overall, the transportation market, it kind of went flat here, but it's been relatively positive for the past few quarters. This is all before the transportation bill that looks like it's going to get passed. If we look at regional data, a little bit more of a mixed bag. The Northeast is a little bit weak, Canada pretty much flat. The others are up a little bit, but not hugely. We look at the submarkets in transportation, all positive with the exception of airports and rail, which is not negative, but they're kind of neutral. And again, once this new transportation bill comes out, we're hoping that we see a lot more proposal opportunities. Moving on to education, it was flat for a long time, but it actually started to come back and looks like is actually in pretty decent shape now. Look at education, the education market regionally, all pretty positive. And if we look at the submarkets, for the first time in a long time, all the education submarkets are actually pointing up. People are seeing more quarter-over-quarter growth in proposal opportunities. Moving on to water and wastewater, we see, again, a market that never really went into recession, at least not nationally. It certainly did in some places like Nevada and Florida, but not nationally. And if you look at the last few quarters, there might be a little bit of a tailing off here, so we kind of have to keep an eye on that, but at least for now, it looks pretty strong. If we look at regional data for water and wastewater, it looks pretty strong across all the regions. And if we look at all the submarkets for water and wastewater, every single submarket looks strong. People are seeing quarter-over-quarter increases in proposal opportunity. If we look at other government buildings, this is everything. This is a hodgepodge of things from libraries to city halls to police stations, all kinds of things like that. This has been a market that was down for a long time. We're starting to see some signs of life, we think, in this market, finally. Not so much in Canada. In fact, in Canada, we're seeing the market for other government buildings actually declining. But in the U.S., all the regions are positive right now, according to the latest snapshot, third quarter of 2015. Looking at the subsectors in this market, all of them are positive with the exception of justice facilities, which are kind of flat. Speaking of Canada, a couple of years ago, we warned that there might be a slowdown in Canada coming, and that was a result of three things. One was flattening of energy exports. The second is a rapid run-up of housing costs, and third was an increase in household debt. All three of those things are kind of bearish for the overall Canadian economy, so let's see how that's doing. According to the most recent data that's available, Canada is technically in recession. In other words, there's been 2 quarters in a row of decreasing GDP. However, most people think that that's going to recover soon, and I believe that they're probably right. So we're thinking that that's probably more of a dip than it is a long-run trend. Let's look at PSMJ proposal activity for Canada. And what we see is we saw a negative year in 2008, but actually proposal opportunities are hanging in there pretty well. From 2000, they were flat in 2012, but 2013, 2014, and 2015 still look pretty positive. So, advice to Canadians. Number one, just to kind of keep your powder dry, avoid any long-term overhead commitments. Don't sign up for long-term leases on a whole lot of excess office space. If you do have a long-term lease, get some kind of an escape clause if you have to. Now is not the time that you have to cut overhead, but it's probably a good time to have a contingency plan to cut overhead in case the current dip does turn out to be a trend. What are some troubled business units that might need to be cut back or even cut out? Are you making marketing investments that have questionable returns? And are you carrying employees that are mediocre or worse? Those are all areas that are ripe for cutting overhead. And the third piece of advice is it might be a good time to expand into the U.S. So to summarize all this, this one chart is a summary of where proposal opportunities stand in all of the major markets. The red circles are the second quarter of 2015. The blue triangles are the third quarter of 2015. And you can just visually see that for the first time in a long time, every single data point is to the right of the zero line, which means every market is seeing more proposal opportunities quarter over quarter, both in the third and the second quarter. The strongest ones are commercial users. Transportation seems to be coming on fairly strong. Healthcare with some caveats. If we look at the hottest submarkets, these are the ones that have the strongest plus-minus index in our latest survey. Continuing care facilities, retirement-assisted living, multifamily housing, and so on. These are the ones that seem to be the hottest right now. But there's another factor that I think is often overlooked when people are deciding what markets to get into or get out of. And that is not just how strong is the market in terms of potential revenue, but what's the potential profitability of that market? So we did some analysis here, and we looked at each of the major markets in terms of the profitability of that market. And the way we measured that is we looked at the profitability of firms in our database that do more than 50% of their work in a given market versus the overall profitability for the A&E industry during that same year. So let's take transportation, for example. You can see in 2015, there was, in our 2015 survey, which was for 2014 data, firms that did most of their work in transportation had 4% less profit on average than the average A&E firm. And in fact, you can see going all the way back to 2011, every year, we colored them in pink because they weren't quite as dramatic as the drop in red, but kind of color-coded these. And you can see in transportation, every year, firms that specialize in transportation seem to have somewhat lower profitability than the overall A&E industry. There's lots of reasons for that, but we could go into those at a different time, but certainly that seems to be the trend. Government buildings in general 4 out of the past 5 years, firms that were in government buildings actually had more profit than the average A&E firm. And in the most recent years, it was 2.3% more. So actually, that's a pretty profitable market overall. Water and wastewater, kind of a mixed bag. We've had some really good years, 2011, 2013. This past year was kind of flat, had one down year. But overall, water and wastewater, on balance, appears to be somewhat more profitable than the overall industry. Industrial is very profitable. In fact, some years it's been extremely profitable. Back in 2012, the difference was 14%. But every single year for the past 5 years, firms that specialize in the industrial market are more profitable than the average firm. Energy and utilities kind of bounces around a little bit. It's gone from being really profitable in 2012 to actually being less profitable in 2015. Commercial, again, bounces around a lot. The most recent year is very profitable, but the year before that was very unprofitable. So a lot of variability there. Commercial developers, again, a lot of variability. It's gone from less profitable to way more profitable to still pretty much more profitable. So in the commercial arena, when things are good, they're really good. When things are bad, they're pretty bad. Housing, again, very much a mixed bag. When they're good, they're really good, like 2014 and 2013. But when they're really bad, like 2011. And then healthcare, that's, again, more of the data that we've shown. And that seems to be a trend from very profitable to not so profitable to not at all profitable. So this is another factor that I think you really need to consider when you're doing your strategic planning on what markets to focus on. So if we take all that and try to wrap it up into a summary slide, this is what we came up with. We look at 3 factors. What are the short-term prospects? How do things look over the next year or so? What are the long-term prospects? How do they look over the next 5 to 10 years? And then how profitable is that market likely to be? So we take each of those and we just qualitatively assign a value of -2, meaning terrible, to +2, meaning great for each of those, which gives us a range of -6 to +6. And then we ranked each market accordingly. The dark green are the strongest markets, the light green are not so strong, and the red is weak markets. And you can see that right now housing is the #1 highest rated market that we see, followed by commercial, and then water and wastewater, government buildings, and so on. The lowest one that we see right now is energy and utilities, which is actually negative. What's really interesting is if you look back as recently as 2012, here's energy and utilities. It was on the top of our list back then. And so you've got to be very careful, and you've got to really look at these things on a regular basis, because things can change pretty rapidly. So what do we do with all this information? We believe that the current state of the markets for most of the A&E industry is going to be moving our industry away from focusing on winning the war for clients and moving toward winning the war for talent. Now, what happens if you raise your salaries for everybody and at the same time you hold your prices steady? Not a formula for financial success. So, I'll just ask rhetorically, how many here, and this is a question that I've asked for many groups for a lot of time, how many people here have raised your prices in the past 2 years? And I can't see the audience here, John. So, John, I'll ask you to look at the audience and see, everybody raise your hand and tell me if you've raised your prices in the past 2 years. Let's see a show of hands. I'm guessing there's quite a few hands that have gone up.
That's about 90%.
About 90%?
Yes.
Now, the next question is, I want you to raise of the 90% that raise your prices, I want you to raise your hand if you regretted raising your prices because you lost too much work as a result of raising your prices. So, John, what percent of the hands are up now?
0.
0. Okay, so what does that tell us about raising prices? It tells us that our industry has been too cautious about raising prices. So our recommendation to you is raise your fees, which allows you to offer higher salaries to attract the best and brightest employees, because that's really going to win the war for talent. So with that, I'll open it up to any questions or comments that anyone has.
Here we go. First question.
Hi, Dave. My name is Brett. One of the questions that I have is contained to the last statement that you just made about raising fees. And what we have found is that when we try and raise our rates, that's fine, except when we go into negotiation with our clients. And our clients successfully hold us to the point of either accepting the rates that they're proposing, or they will move on to the next available consultant to do the work. And so, in essence, we get beat down in holding our rates up high, even though we'd like to raise them. So I didn't necessarily raise my hand in the last session or the last questioning, because it's kind of a false leader. We don't have that luxury, if you will, just to set our rates and say this is what it is, except to walk away from the projects. And generally, we are working on projects that may have been in the pipeline for 3 to 5 years that we've been chasing. They're large. It's good work for us. It's resume builders, and it's things that are generally public work.
Is there any more to the question, or is that it?
Well, that's the observation, and that's a circumstance. How many people are seeing that out there? Show of hands. Oh, about half the room. About half the room are seeing that right now.
Yeah, and there's no question that's going to happen. When you raise your prices, you're going to have your most price-sensitive clients leaving you for somebody lower. There's 138,000 firms in the U.S. alone, and another 20,000 in Canada. Somebody's going to be lower than you are when you raise your prices. The real question, though, isn't whether you're going to lose work. The real question is the loss of revenue going to be more serious than the increase in the margin that you get? Because you really have to balance volume and margin. We spend a lot of time on that. If we actually have a model that we can use to do that, and I believe we even have a webinar that we talk about that. So if anybody's interested in getting that information about that webinar, give me an email. I'll give you a link. It's a free webinar, and you can see more about how to optimize the mix of volume and margin in your markets. Because there's no question, you will definitely lose work when you raise your prices.
Okay, next question. Speak loudly, clearly.
Hi, Dave. I'm Lilia Abram, Peer Consultants. First of all, thanks for acknowledging being a diplomat. I'm also one, and I'm so happy when we recognize environmental engineers. I have a question about your coming to the conclusion that the energy utility markets are weak, but early in your presentation you talked about the booming renewable energy market. Are you talking about the centralized grid or microgrids and renewable energy? Because we're finding that to be booming. So would you please give a distinction?
I didn't catch, I caught some of that, but I didn't catch it all. Frank, can you repeat that?
All right, you said that your energy utility markets you rated as weak. But early in your conversation or your presentation, renewable energy markets, especially solar, are really booming. So would you please make a distinction as to which markets you are talking about for weak?
Well, that's a really, really great comment, because, when we talk about the overall energy market, it's comprised of a number of submarkets. The dominant part of that, the big dollar amounts are in conventional fossil fuels. And so that's what really drives the overall market. But to really focus on, to really have a strategic plan for marketing properly, you have to dig deeper than that. You have to get into the individual submarkets. And you're absolutely right. We are very bullish on the renewable market. So while the fossil fuel market right now doesn't look very good, the renewable market looks great. So that's why we give you all the data on the submarkets, because that's really where you have to do your planning, not at the overall market level, but at the submarket level. That's a great question, a great observation.
Any other questions? Any other questions? Because I have one. All right, Dave, Here's a dilemma that we see in a lot of these firms, and that is we are so busy right now in a current hot market. What do we do to move into another market? How many people are really busy right now? Raise your hand. All right, so everybody's really busy, but here we have some predictions that some of the markets they're busy in might not be busy 2 to 3 years from now. What do we do to move?
I think there's a historic opportunity right now to make acquisitions of small companies, small A&E firms. We were discussing this just yesterday, and we represent a lot of buyers and sellers. And frankly, you may remember the number better than I do, but I think the ratio of buyers to sellers that we're representing right now is about 10 to 1, right? For every buyer we're representing 10 sellers. So it's a buyer's market out there. And what we're seeing is there's a lot of relatively small and mid-sized, well, more of the small firm, under 100 employees, and a lot of them are under 50 employees. Acquisitions that can be made relatively easily without a huge financial investment, without a huge risk, where they're looking to sell. And they're already in those markets. I think this is a historically great time for buyers to make acquisitions of smaller firms.
Okay, we have another question in the back. I'm coming. Hold on, Dave. While I'm walking, I'll give a little PR for Dave. If any of you are in state associations or state groups that would like this economic presentation tailored to that state or region, Dave would be happy to travel to you. So just make a note of that and contact us, and we'll get Dave to you.
Yeah, in fact, I've done that in several states.
David, it's Barry LePatner. How are you? Hope your family
Barry, how are you?
situation clears up and you're back with everybody soon. David, one of the things you didn't touch upon, but is becoming one of the biggest issues in the AEC world, is the fact that owners are beginning to demand more technology from their AEC team members. And it turns out that technology costs are going up and cost a lot of money, but they are becoming much more prevalent over the next 5 to 10 years. Have you done any studies to show that firms that invest in technology, training their people, can have the ability to raise fees and show the value added to clients?
Yeah, in fact, we've looked at that a lot, Barry. And what we've seen, if you look at our financial performance data over the years, what we've seen has been a steady increase in overhead rates of firms, primarily driven by technology, both to increase the overhead costs for buying and maintaining the technology and the people that maintain it, but also a reduction in direct labor costs because you don't have all those drafting rooms full of drafters that are charging 40 hours a week to jobs every week. So that overhead has been going up, which means that if you're going to maintain your profitability, you have to raise your prices. Now, the question is, does having high level of technology allow you to raise your prices? And the answer is yes, but you also have to have the courage to raise them. And what we see in our industry is there's a lot of people that have more ability to raise prices than there are people who have the courage to actually go out and do it because they're so concerned about losing work if they raise their prices. And I think one of the messages that we try to give across is, yeah, you will lose some work, but overall, the work you lose will be the work that's the least profitable, the least desirable, and the least enjoyable, and it's going to allow you to focus on your best clients and make higher margins.
Take it off here.
I did some strategic planning for an architectural firm a few weeks ago that when they sent me their financial data, I thought there was a mistake because their billing rates showed a 4.5 target multiplier. And I asked them, was that a mistake? And they said, no, that's what it is. Then I looked at their actual multiplier. They were achieving 5. And they've been achieving 5 for the last 5 years. So it can be done.
All right. Any other questions? One more question. All right, we have time for one more.
Can we have a copy of this presentation?
Yes, there is a copy available. You can have the whole thing. You mean of the actual presentation, the video? Well, we are videoing it. You're seeing it, so it's going to be available for sure. Okay? All right, I'm going to turn it back over to John. Dave, hang on the screen for a couple of seconds. Don't go away yet. John, back to you.
All right. Well, I'm not sure when you're supposed to do this, but let's give him a big round of applause for that.
Thank you very much. I actually didn't hear that.
I took a few notes during the session. I know a lot of you did too, but I might have taken some slightly different notes from you. First thing I wrote down was, boy, am I glad I didn't have to do this and stand in for Dave's presentation, which was a working plan B at one point yesterday. I'm so thankful that Dave spends all the time and energy keeping up with all this data, and I hope you guys find that really, really valuable. Second thing I wrote down was, no, Dave, I don't remember much from calculus course. The third thing that I was wondering, and I'm sure you weren't, was, do you think Dave has his suit pants on that match that jacket? Or should we not even go down that road?
Dave, I don't think you heard that one. He said, dude, does Dave really have his suit pants on, or is it just his sport coat?
Hey, wait a minute. Here we go.
Now I have another thought, which is I'm glad I wasn't the one doing that, because I probably wouldn't have had my suit pants on.
Thank you again, Dave.
Thanks again, Dave.